Hi everybody, welcome to the complete MBA course. Today we will learn what accountants do in organizations. So let's start. First of all, I wanted to give you a very short introduction of what a chartered accountant is. Also called CAs, they are certified professionals by a certain official accounting organization. Some important certifying organizations you should have heard of are, for example, the ACCA. That one is the Association of Chartered Certified Accountants and is internationally used. Europe, Asia, Africa, most of them use them and is concentrated on what we learned on last videos, the IFRS principles. The second one is the CIMA, or Chartered Institute of Management Accountants, and is very well known in countries of the Commonwealth. For example, UK, Scotland, Australia, Canada, etc. Each one of those countries has its own version of CIMA, so if you're living in one of those, I recommend you to check how is it called after this video. The third one is the IACPA, or American Institute of Certified Public Accountants. This one is only valid in the US. However, given the economic importance of that country, is largely used in international companies. Chartered accountants coming from AICPAs are called easily CPAs and are expert in US GAAP. Well, that's about the main chartered organizations. Now let's check what accountants can do for you in your business. This is what a chartered accountant's work is. So what are the main responsibilities of an accountant? This is a typical exam question on MBA, so you should better memorize them. Firstly, accountants do what we call compilations. They create financial statements and make sure that the business complies with the financial laws. For example, they may calculate the taxes you need to pay based on your economy activity. Secondly, they do what we call controlling. That means that they analyze the financial results of your company and help managers make decisions based on it. For example, they may make weekly meetings with the operational manager and explain them if there is any overspending detected or if their personal costs are too high in comparison with other business units, etc. The third work is what they call auditing. Accountants, while they audit, they investigate and gather evidence of all kinds of problems in financial statements. When accountants do audits, they provide something called positive assurance. I'm going to write it down. Positive assurance, or plus, which means that they certify that the correctness of your documents. The fourth and last work that the accountants do is what we call attestation. This means, like in the auditing one, that they investigate and gather evidence of problems in financial statements, but in a more limited way than in auditing. That's why attestations provide negative assurance. Meaning that they only certify that the information presented by your organization seems to be correct. So those are the main four works that accountants do in organizations. The next step for you to understand is which are the main reports that accountants create for a company in order to do these works. These are called financial reports. Good, so the so-called financial reports are so important that every company has them in a more or less standardized way. And all managers need to memorize how they are calculated to understand the status of their business at every moment. What I'm going to do now is present you the main ideas, and then in the following videos we will explore these so-called financial reports more in detail because they need to be studied as they're very important. The first of one is called the balance sheet, also called the financial position. This document is just the summary status of all the assets, liabilities, and equity at a certain moment in time. if we check the COA that we learned in the last videos, that will be the summary of these accounts here, these accounts here, and these accounts here. The second one is the income statement, or also called financial performance. It's just a summary of the revenues minus the expenses, which is the other accounts here. When you do the revenues minus the expenses, results in the company's net profit of the year. The last one is the statement of cash flows. This is a document that helps you understand which accounts of the balance sheet changed and identifies where was the cash used. It helps you avoid running out of cash, which is an important problem in big businesses, as discussed before in the previous videos. So good. Now that you know about the main financial reports, these three, it's the moment where you need to understand the main equations that relate the accounts on them, which are they are called accounting identities. Let's go to the last slide. So what is an accounting identity? An accounting identity is an equation relating important accounts on your COA. There are three main ones that you need to learn to identify. The first one is the balance sheet identity. This one helps you calculate the equity, which is the ultimate value of a company. It's an equation that has three parts. So the first part is the assets, which is basically everything that the company owns. For example, equipment, cattle, locals, furniture, cash in the bank, etc. The second one is the liabilities, which is everything that a company owes to third parties. Some examples are those accounts that we discussed in previous videos, such as bank notes or government due taxes, supplier debts in general at the end. And finally, the third and most important one is the equity, which is everything that the company owes to the shareholders. Rearranging the equation, it is very easy to see that the shareholders can claim from a company the total value of their assets minus the total value of their liabilities. When companies grow, their assets account grows quicker than the liabilities account, and therefore the equity gets higher. That's why shareholders get richer when a company grows, and that's how capitalism works. So the second most important identity is the income statement identity. This one is a bit more obvious than the previous one and relates the rest two main accounts of your COA, the income and the expenses. So your year's net income is the subtraction of those two, simply. Shareholders are usually very interested in this one because it identifies and defines the increase of equity of a company from one year to another. Higher net income means that the next year the equity will be equal at the equity of the previous year plus the net income that you had. We'll see that more in the next videos, don't worry. The third and last one is the cash flow identity. That one helps managers ensure that the business has always cash in the bank. This one is even easier to understand than the last two ones. So basically what we say is that the calculated cash that you have at the beginning of the year and then uses the accounts where the cash is exchanged to understand your current cash quantity at the end of the year. The cash journal, for example, that we saw in another video, uses this identity and helps you understand it. So, well, that's for today. In the next videos, we will dig deeper into each one of those financial reports. But as always, remember to subscribe if you like me to my tutorials. And if you're doing an MBA, check out the comment section to the links to my book, which is a complete guide to pass a top-notch MBA with the whole theory and all the exercises that you need, and you're gonna do that. So thanks for watching and see you in the next video. Bye bye.